Hi traders, let's get started for this webinar then. Welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week, of the market's key events and trading opportunities. Whilst I'll just let you have a look at the disclaimers, I'll just briefly run through some of the objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase in decrease or decrease in importance over time. Our goal really is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way, or you can write them in the chat box and I will answer them as best I can, and at least after the webinar finishes. Okay, this week we'll look at how markets are shaping up at the moment, midweek. We'll just check out a broad theme that we've sort of quite like and have noticed recently. We'll look at the earnings season so far and going forward actually for equities, and then look at some of the technicals around some of the US stock indices. We'll briefly then have a look at or review the Bank of Japan meeting from last week. We think it's a critical meeting and a potential theme, a potential big driver of markets for this year actually. So going forward, we'll briefly recap as well some of the UK data from last week, important for sterling, for the Bank of England potentially, and then we'll crack on with this week's events, look at the dollar and US GDP as well as core PCE data on Friday. That's the Fed's favored inflation gauge, and then hopefully wrap it up with a look at the Bank of Canada meeting, which is this afternoon, and of course we'll look at all the associated currency majors, so dollar CAD, of course, dollar yen when we're looking at the Bank of Japan meeting, and of course cable, so sterling against the dollar when we look at the UK data. Okay, so markets this week relatively quiet. The dollar's still really languishing near its lows, and stocks have been mildly bid the last week or so. US futures in the red actually for the moment, so indicating a lower open in the US stock indices today. That's after Microsoft earnings, which we'll go into. Which were pretty much initially thought of as pretty decent, but guidance has meant the stock is, I think, now lower in the grey market, and US futures are pointing, as I said, to a lower close. We should remember trading conditions in Asia have been quiet because of China being out for the week, actually, for the public holiday for the Lunar New Year. And then hours in Asia is also limited as well this week. Hong Kong actually reopens tomorrow after being shut from Monday to Wednesday, and also Australia's market closes tomorrow for Australia Day. Probably a good time, quick review of asset sort of market performance year to date. Really shows equities performing well, European and Chinese equities especially leading the pack, up around 7 to 8% on the year. Bond markets also been performing well. That means prices have gone up, so yields have come off. Remember that inverse relationship. And then in the FX space, we can see this brief small graphic here. We can see really the antipodeans, so the Australian dollar, the Kiwi dollar, really leading the way against the dollar. This is the US dollar year to date. Obviously, the China COVID U-turn or the U-turn in its COVID policy has been a key driver of this. Commodities really finding a bid and going well. Copper, gold as well, of course. Oil has bounced back, so that's really led to those two currencies, Aussie dollar and the Kiwi dollar, of course, doing well. Certainly as well, we've seen overnight, worth pointing out, although the Aussie has given back some of its gains overnight, Aussie surged actually over 1% at one point, to the highest level actually since early August, and above 71 after basically hotter than expected CPI. The RBA's actually preferred trimmed mean measure picked up more than expected in Q4 to 6.9% year on year from 6.1%, and that was the highest level since 1988. So the odds for a 25 basis point hike at its February meeting, the RBA's meeting, have actually increased now to around 80%, I think, from pretty much a coin toss 50-50 before the release. And there's now around 65 basis points of total additional tightening now priced in for the RBA. A peak rate, I think, of around now 3.75% priced in by money markets. And that has obviously boosted the Aussie, and will be interesting going forward. Obviously, a load of central bank meetings in February. The broad theme I wanted to touch on was briefly really obviously the global economic cycle that we're all looking at, we're all trying to study and work out. I'm really kind of weighing up the options between whether we get a soft landing, of course, or something worse, a bigger slowdown and potentially a recession. And of course, while US, say, housing data, survey data has been weak for quite some time now, it's the real economic data that is now starting to show more of a deterioration. And markets also, they're evolving on their interpretation of economic data. And really now we're moving from this point where bad news in the economic data was actually good news, because that suggested the Fed would pivot on its rate hike cycle. And then that provided a bid, of course, to equities, to risk markets. But now we're kind of shifting towards bad news is bad news. And we've thought about this a lot for many, many years, really, trading fixed income markets, bond markets. But now, obviously, this dynamic sort of enters into sort of more popular thinking. So bad news is bad news, and really that means the Fed isn't pivoting, and it's the Fed's tightening cycle which is the worry, because then that is affecting the growth outlook. That shift in perspective in the near term, at least, brought on by that weak set of US data last week. If you remember, retail sales in the US, they fell worse than expected, and they've fallen now by 1% or more for the past 2 months. We also had industrial production that's fallen for the past 3. And kind of has all stirred concerns about the health of the economy, about the US consumer with regards to those retail sales. And then we also had manufacturing output as well declining, and deeper revisions as well, prior revisions to the downside. One thing as well, though, actually to note from last week was the fall in PPI. So that's the producer price index. That fell more than expected. That is sort of the lead ahead of CPI. Instead of those consumer numbers, then it's the producer price index, which goes into making goods and the cost of goods. And as the costs of energy and food costs have declined, it's kind of offering more evidence that inflation is receding. And again, if you think back, this comes on the back of the previous week's release that those consumer prices fell for the first time in more than 2.5 years in December. Yeah, we can just see on this chart where the dark blue line, the CPI number, but then you have the PPI kind of leading it and falling sharply. So potentially more falls to come, sharp falls to come in those CPI numbers, which have been a driver, of course, of the dollar, of the weakening dollar, of yields and treasury yields. If we just move on now to equities, let me just pull up a chart first of all. We've got the S&P 500 chart here, but generally, obviously, all the focus on Q4 earnings. That's really accelerated this week with key results from Microsoft that we saw overnight, and then to come this week we have ASML, Tesla, Visa, Chevron tomorrow, and well, overnight actually Tesla after the US closed tonight, and then Visa and Chevron Thursday, Friday. So that comes obviously before then we get the mega cap tech titans, if you like, next week as well to look out for. So Apple, Amazon reporting next week. In the meantime, the aggregate earnings surprise for S&P 500 companies as reported earnings is currently 4.1%. And the market has generally responded positively to Q4 earnings reported so far, with case in point being Netflix, 8.5% jump on Friday on its strong outlook for advertising business, its advertising business, sorry. But regarding S&P 500 and tech companies, they make up 26% of the market, and they're expected to report a quarterly profit drop of 9.2% on average, according to Bloomberg. So this could be actually the biggest tech drop since profit drop, that is, since 2016. And forward 12-month earnings of 39% is also expected, according to Bloomberg. The potential danger is then that these estimates are still too bullish, and markets will likely be disappointed. And then that obviously could trigger a fall in the indices. Just more in the near term, we mentioned Microsoft. They reported last night missed revenue estimates by a small margin, but hit the EPS consensus estimate. As I said, the initial reaction was slightly positive after hours, but then the outlook of weaker guidance in its commercial business has seen the shares sell off. And then moving on to Tesla, revenue growth of 36% year on year, and EPS of $1.12 is expected. Estimates are still very bullish for 2023 as a whole, with expectations of 30% revenue growth, despite a lot of those delivery issues. And then key probably will be comments on the recent price cuts on car models, and if then demand can make up and offset that price reduction to hit the or affect the bottom line growth for this year. Regarding technicals, then we can see on the S&P 500, we are still toying with that key resistance level. This is the weekly chart, still toying with a sort of 4,000 level. Key psychological level, of course. We also have that 50-week moving average. We have that falling trend line resistance. If we just go to the daily, you can see as well the 200-day moving average now 3964. So sort of key resistance zone, potentially support as we pushed above there now. But that is obviously getting a lot of focus. If we can push higher, we can consolidate above sort of 4,000, then we'll look to the December pivot highs around 4,100, which are not far off. And then obviously that probably tallies with that, yes, mid-September high around 4,119. If we do push above there, then we've obviously got the 4,200 level, which is those highs from late August last year. Support then will be potentially the 4,000 level, the falling trend line, acting as support, then flipping from resistance to support potentially, and then the 200-day moving average as well. The 50-day moving is below that light blue line, 39.38, all offering potential support then to this kind of slightly surprising but welcome surely the bid to equities to start this year. Other indexes, other indices, the Nasdaq, we've said sort of probably over the last weeks or so, we mentioned that the Nasdaq tech heavy index, of course, had some catching up to do, and this break again above that falling trend line is quite positive. You can see then it hasn't broken the 200-day moving average, but it's much closer than, of course, it was. That comes at 12,036. if we just go to the weekly, we've got some long-term fib levels here actually. One of those being the halfway point of the pandemic low, so long-term fib level to the all-time highs. That comes at around 11,768, so we're sort of just above there as well. So interesting level, potentially then moving higher up towards the December again, those pivot highs around 12,166. And that 200-day moving average, as we said, 12,036. So interesting levels for the Nasdaq, certainly with some of these tech earnings coming out and being potentially a big driver for that index. One thing we probably might have pointed out before, but probably good to show you now, is just around the outperformance of European stocks over US stocks. You can see this little chart here from the start of the year, and really interesting that so European stocks looking good still for the whole of this year. You can see the pink line is sort of caught up to the S&P and then overtaken it, obviously in outperforming for the back end or the last week or so. European stocks, big outperformance, is still doing pretty well. That all comes on the back of obviously this warmer weather, lower natural gas prices, and then also the ECB potentially shifting in gears, certainly from the 75 basis point hikes that we have seen to 50 basis point hikes, although that is nailed in for next week actually, but definitely that downshift in gears is a key driver probably going forward, and whether actually now European stocks that have performed so well, of course there was so much negativity sort of Q3, Q4 of last year, European stocks now outperforming, but potentially then we think the focus should be on the ECB and whether they then back up that 50 basis point hike, which is nailed on for next week, then with another one in March, and that it's not priced in yet, so potentially may have an effect on the euro for sure, but also then European stocks and be a driver for them going forward. Okay, one thing probably to show you actually, yeah, you can see, sorry, the outperformance there. I just want to now move on to the Bank of Japan and look at dollar yen as well. Let me just pull up this chart, which you can see here. Yep, here's the dollar yen chart. So yeah, worth recapping the Bank of Japan meeting, we think, just because of course of that surprise tweak to its yield curve control policy and the yield curve band, which allows the 10-year JGB, the Japanese government bond, to trade within a certain band. That was at 0.25% plus or minus. They tweaked it to 0.5%. A real shock just before Christmas during the holiday period, really, and a real shock to surprise to markets. Kind of justified by the Bank of Japan as being a tweak to enable better market functioning of the bond market, which has pretty much seized up, the Bank of Japan owning the vast majority of JGBs, but markets are really expecting and did do, of course, last week actually another further adjustment, and so the unchanged policy was a disappointment, certainly to FX markets, which had positioned, as I say, for another adjustment. Arguably, in a way, we kind of got ahead of ourselves, and in fact, some of the 2-year government bonds, the swap rates had jumped actually in anticipation potentially of a rate hike, so they've pulled back down certainly. The Bank of Japan also, we should say, released its forecast for economic activity and prices. It's essentially, it cut its GDP outlook and then raised its CPI inflation outlook for this year, but for next year, 2020, for last year, I should say, but for fiscal year 2023, the forecast remained unchanged at 1.6% for CPI. This is the Bank of Japan forecast. So really, they indicate that the bank will continue to pursue its 2% sustainable target, as it kind of sees the recent higher than usual CPI around 3.9% or so, near 4% potentially. It sees that as transitory, temporary, and really that will be past the peak. And that's despite, of course, the extraordinary inflation that we've seen elsewhere. Most economists as well, Bank of Japan watchers, Japanese economists think that risks are skewed to growth to the downside as well. That's based on recent weak activity and forward-looking data. So really, the bank at the moment believes, at least, that the economy is not ready for a reduction in stimulus yet. And in a way, it was kind of a don't fight the, I think one investment bank put it, don't fight the BOJ, similar to sort of don't fight the Fed, that phrase, but don't fight the BOJ just yet. They kept its key rate and the yield curve control policy unchanged. And really interesting with this evolving global backdrop and having held firm in January, whether we then don't get any more changes, certainly before Governor Kuroda steps down in April. That means the historic divergence in rates between Japan and the rest of the world, as Japan still keeps a relatively ultra dovish policy, really, compared to everyone else, the rest of the world, then we don't really see any change before, yes, Kuroda steps down. Interestingly, then, their forecasts anyway for the moment point to CPI. I mentioned fiscal year 2023 and even 2024, they remain below 2%. So potentially that also makes the case for the new Bank of Japan governor in April to possibly even continue with the ultra loose policy. But for dollar yen, interesting. I think kind of that is one flip, but the flip side really is that we do get some change ultimately in the Bank of Japan policy going forward after April. Certainly dollar yen, it will be interesting, with the new nominee for the governor. I think that's presented in next month in February, and then there's a sort of March-April window when Kuroda hands over the reins, if you like, of the governing board to the new governor. So certainly there will be a lot of speculation around volatility potentially. We even got some today, I think, an ex-Bank of Japan official saying that there would be changes to policies going forward potentially in the next few months. So we have to be alert for this, and dollar yen certainly being volatile, and one of the most volatile pairs actually in the G10 space, really living up to its name. You can see on the chart then, this green candle, that was on the Bank of Japan announcement. You can see the disappointment, so yen selling as we got sort of close to the top of this descending bear channel, but then did look very bearish actually, that we then closed much nearer to its lows. Kind of rethink really from markets that, yes, so we don't see any changes from the Bank of Japan up till April probably, but then speculation we think will ramp up. Interestingly, we've sort of tapped the top side of this channel, haven't been able to break it as yet, so potentially we sort of oscillate around the sort of 128, 132 area as a range. But if we do decisively move above here, then we do have probably, if we just drop to the weekly, we've got a couple of fib levels, but we put on a wider one actually, which is sort of 2021 lows up to the highs above 151. and the halfway point actually was 127.26. You can see, which we tapped last week. So that offers support, it looks like, nearer term fib level of last year's rally at 128.16 as well. And then sort of above there, resistance comes in at 133 and 132.70. If we just pull on the daily, you can see 132.70 is there. So that would be a breakout of the descending bear channel, that series of lower lows, lower highs, which has been sold into really. So yeah, interesting juncture. $4 yen, big major, and potentially things to look out for going forward as we move through the year. Okay, over to just a brief recap of the UK data from last week. If I just pull up first of all one of the charts we want to show you is UK inflation sort of falling from its peak. You can see headline inflation and then core inflation. The December numbers, they kind of matched consensus expectations. Headline, that decelerated from 10.7 to 10.5%. The core sort of held at 6.3%, so unchanged from November actually, and that was above expectations for a slight drop to 6.2%. Interesting really, these numbers still of course in double digits, still more than 5 times the Bank of England inflation target of 2%, remember. And also really it's important, we think, a number that the MPC look at, which is core services, that jumped from 6.4% to 6.8%. And as I say, yes, certainly something that the Bank of England policymakers there will take into consideration. You can see, yep, still elevated then, and potentially will drop going forward, but is still, still in double digits. Going forward, potentially by the summer, I think various economists think that inflation, headline inflation, will return to 6% or so, and then by year end to sort of 3-4% potentially. But that is much further out in the near term then. We also had strong UK job market data. Unemployment remained unchanged at 3.7%. We had jobs rising actually against expectations of zero growth. And then importantly, we had average weekly earnings rising 6.4% against forecasts of 6.3%. And that was up actually from 6.1% in October. So an upside surprise in wage growth. Rising really at a near record clip actually, and it kind of leaves Bank of England in the near term at least with very little room for maneuver on its rate decision next week, next Thursday that is. Markets pricing in pretty much a 50 basis point rate move, around 46 basis points I think are tightening priced in. That's marginally up from last week after the data, the CPI and the jobs data. And it's also given a little lift to sterling, although retail sales are actually on Friday disappointed, just sort of hinting at issues for consumer activity in the UK going forward. Certainly for sterling then, if we just look at the chart, let me just pull up cable. We're just sort of rolling off. Here we go. Here's the cable chart on the daily. Interesting really. Yeah, we've had a decent bounce obviously from that low, the early sort of 2023 low at least. Certainly there's been a marked improvement of course in the perception of UK sovereign risk. Certainly of course from the sort of shocker we had in September. And that's and the firming up actually of sort of Bank of England tightening expectations potentially at least next week has sort of given a lift to sterling. Whether then we're rolling over, it looks like interesting on potentially the Bank of England then slowing. That will be key. We did have data, just sorry, checking the calendar. We had data, the PMI data actually yesterday out of the UK. That again showed both manufacturing and services components remaining in recessionary territory. Sub 50 then, those readings, but manufacturing was slightly better than the estimates. Cable then all looks like this resistance level is holding so far, 124.52 around there, those mid-December highs. A real issue for cable and being able to push higher potentially. Just looking back then, that we had that bullish engulfing candles sort of started January and just a sort of gentle move higher. But as I've said, 124.52 is a key now resistance level. We've got support probably from the 50-day moving average at 121.38. Around there probably if we do happen to roll over slightly. But all eyes will be on the MPC meeting next Thursday. Okay, we'll move on now to some of the dollar stuff happening this week. Also the DXY, this chart here. Certainly there's lots to focus on in the near term or the data obviously this week, but also then we should highlight next week. We have the Fed meeting on Wednesday evening UK time. Then we have the Bank of England meeting decision and the ECB decision as well the following day. As well as I think we have Google and Apple on the 2nd of February. So some huge risk events to kick off February, to kick off next week to look out for. Near term, we have tomorrow reasonably strong fourth quarter 2022 US GDP data, 2.8% expected quarter on quarter annualized. Although that strength may be driven by the trade side actually and on the back of weak US imports. Consensus view is more pessimistic actually than the Atlanta Fed's GDP now forecast. Many people track that and that's looking at growth at around 3.5% actually. But definitely we always have to think GDP is a lagging indicator, and obviously as we've said sort of several economists, numerous economists think the growth dynamic will of course slow significantly. Obviously then whether we get a big slowdown, recession, or just really a soft landing will be interesting. Policymakers are generally kind of given constructive updates on the prospects for growth, but obviously we've talked about this already, and whether then it's interesting the Fed is actually still forecasting growth of just 0.5% in 2023. Friday then we see December personal income data, and then as we mentioned the core PCE deflator, that's the Fed's preferred measure of inflation. Core PCE is expected to rise 0.2% month on month in December. That matches the rate seen in November. And then the annual measure is seen paring back actually to around 4.5% from 4.7%. And there's been a kind of broad deceleration in core goods and services, with the main actual upward pressure on core PCE being from shelter. And that's likely to be quite stubborn. We've talked about that as well. Generally 6 to 9 months, it then affects inflation data, and then sort of through to the second half of next year, this year, sorry, when that will kick in, and some of those softening shelter prices will bring down these inflation measures. It's worth noting as well, we think that all this data will be released, of course, with the Fed's blackout window ahead of the meeting, as we said, next week. But currently, markets are pricing in a 25 basis point hike by the Fed. That's pretty much nailed on. And well, whether this data, PC data, possibly if it's stronger than expected, then potentially we get slightly more pricing for a 50 basis point hike. But at the moment, it's a 25 basis point hike. and then Fed funds rate, peak rate is seen sitting around 4.9% at the moment. So all in, that calendar, US calendar anyway, should kind of probably keep the dollar on the soft side this week. We can see DXY, has come a pretty long way actually, off the highs, of course, and now languishing near those sort of cycle lows. Kind of probably think that the markets won't be probably adding two shorts ahead of the FOMC meeting, and potentially, well, if Fed Chair Powell, if the statement kind of pushes back against some of the easing which is now priced into the Fed funds rate for the back end of this year, 50 basis points or so, I think, priced towards the end of the year of rate cuts, that is. So if Chair Powell still reiterates this line about more work to do, or the work is not yet done, obviously with a 25 basis point hike done, but then more to follow, then potentially the dollar will of course find a bid. It will bounce off this sort of rounding base really that looks like then potentially we do move higher. But we've sort of consistently pointed out these sort of 103 area was support, now looks like it's resistance potentially. So we'd have to push above there really for the dollar to get some legs to it. Otherwise, then this recent low at 101.52 is key for more downside in the dollar and the DXY. Okay, just the other main risk event is in a couple of hours only. 3 o'clock UK time is the Bank of Canada meeting. Let me just pull up the dollar CAD chart here. Not too eventful, but regarding the Bank of Canada meeting, there, most Bank of Canada watchers, they think the bank will, or is on the cusp of downshifting the pace of its hikes. So markets expecting a 25 basis point move, taking rates to 4.5%. There's actually around 17 basis points priced in, so that gives it 68% chance of a 25 basis point move. So there is some room for potentially an unchanged outcome, as well as possibly then a 50 basis point hike if they wanted to really get done, really be aggressive and front load, and then take a big pause. Certainly the central bank, the Bank of Canada, has kept its options open after its lifting of the rate by 50 basis points in December. It said it will be considering whether the policy interest rate needs to rise further as it continues to assess how tighter monetary policy is working and how inflation expectations are responding. So a lot probably rides on those sort of communications from the December meeting about this pause that we do get after probably a 25 basis point hike in a few hours. Data has been kind of close to neutral, mixed really. We've seen slowing on the activity side, especially in forward-looking activity in the business outlook survey that Bank of Canada look at, as well as the housing market, which is slowing due to those rising mortgage rates. But then against that, we have underlying inflation, which is certainly uncomfortably high for policymakers. Inflation expectations, they also remain elevated, and certainly the labour market is still very tight. All in then, that environment probably means the data is not really that soft enough to warrant a pause, nor is it probably strong enough to really continue at a 50 basis point clips. Yes, will be interesting what Governor Macklem says. In December, actually, he remarked that elevated inflation means the Bank of Canada had to be more concerned about under-tightening, so not doing enough. And it will be interesting, yes, whether we get this hike, a dovish hike potentially of 25 basis points, and then we get a pause and a peak is notably sort of remarked upon. Otherwise, then we get some sort of potentially, if say we did get a pause, no hike, but so a sort of hawkish pause, if you like, then really pointing to the fact that they're still data dependent. They want to be flexible, and they will hike in March. Then, well, it would be a surprise, obviously, with that 17 basis points priced in. But then, if the language is hawkish, then you'll see some volatility, some probably whips for action in the Canadian dollar. I should point out actually that one thing to note actually with the loonie, especially, we all know it's highly correlated to oil, of course, but it's not just oil it's correlated strongly with. It's the strongest among the major currencies correlated to risk sentiment, and that's been a key driver of the CAD. Although it's eased in the last few weeks, I think correlations of daily returns are around 60%, so correlated with the S&P 500. So always bear that in mind when you're trading the loonie Canadian dollar. As far as dollar CAD goes, it's kind of been little appetite really. It's been slightly dull last few weeks, trading around sort of 133 up to 135, and then before that in December sort of 135 up to 137. So more recently, little appetite to move it either way. We've sort of drawn in these two lines here, sort of kind of long-term compression, if you like. But really, then we've got the near-term fib levels acting as support. Sorry about that. Yeah, 133.52 is acting as support. That's the halfway point of the sort of August rally, if you like. And we've got that sort of ascending trend line as support as well. If we do break down, then we get down towards sort of 132. That's that mid-July spike at 132.23. Then you've got the 200-day moving average as well, just below 132, as well as a fib level. So potentially we break down there. That would mean Macklin being quite hawkish and saying, again, work's not done. They're flexible, data dependent, but may need to do more than sort of 25 basis points priced in. Otherwise, if we do get a more dovish outlook, dovish hike, then potentially then we push up to 135. You've got those simple day moving averages, the 50-day and the 100-day, just above 135. Okay, that is all we have time for today. We hope you've enjoyed this webinar, and we look forward to speaking to you in a couple of weeks. Okay, take care out there.